Who is ready to leave 2022 in the rearview mirror, at least when it comes to the stock market? The broader markets are stuck in a bear market, and the headwinds continue to put pressure on equities. Some of these headwinds include rising interest rates. Over the past year, we have seen the Federal Reserve increase the federal funds rate 425 basis points. We just got another 50 basis point rate hike from the Fed, and they do not look ready to slow down anytime soon, or at least pause.
Today, the FOMC raised our policy interest rate by a half percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Other headwinds include that high inflation that we're seeing, a weakening consumer, slowing economic growth, and even inflated 2023 earnings that are expected to adjust in Q1 23. All of these things could lead the US into a recession, assuming we're not already in one. So it is important for investors like yourself to adjust your portfolio accordingly and prepare for this year in 2023. The one good thing that this bear market has brought is lower prices, which also in return bring higher dividend yields, making for some great opportunities in some blue chip dividend stocks for you to consider in your portfolio here in 2023. As such, in today's video, this is one of my favorite videos each and every year. I will be going through my top 10 dividend stocks for 2023. Again, all of these dividend stocks won't hit, so make sure you perform your own due diligence before investing in any stock mentioned today. With that being said, let's get rolling. Hey everyone, Mark here, back for today's video on the top 10 dividend stocks for 2023. Now, many of these dividend stocks already reside in my portfolio, and for those that don't, they are high on my watch list. If you are interested in knowing exactly what's in my dividend portfolio, you can follow along as a premium subscriber to my newsletter, The Dividend Investor's Edge, which you can find a link down in the description below. And before we begin, let me take a moment to thank today's sponsor, The Motley Fool. The Motley Fool has a ton of great products and tools for investors of all types and all risk levels. And if you go to fool.com/Mark, you could get a list of their top 10 stocks to buy right now. All right, let's get started with my top 10 dividend stocks for 2023. Dividend stock number 1 is Johnson & Johnson, stock ticker J&J. Johnson & Johnson is a healthcare company operating in 3 separate segments. You have the consumer health segment, the pharmaceutical segment, and the medtech segment. The company currently has a market cap of $464 billion. The consumer health sector has many well-known brands that are always in demand regardless of the economic backdrop. Brands include Tylenol, Motrin, Zyrtec, Band-Aid, Listerine, and many more. The company announced they would be spinning off their consumer health segment into a new company called Kenvue, which is expected to happen in the later half of 2023. This will allow for greater focus on the faster growing segments such as pharmaceutical and the medical devices segment. J&J is going to be among the safest stocks on this list today, which is why I thought it was worthy of the number 1 position. Over the last 10 years, the total return between J&J and the S&P 500 is almost identical, separated by less than 2 percentage points. And for those of you unaware, J&J is dividend royalty. They have increased their dividend for over 50 consecutive years, making them a dividend king. In fact, J&J, with their latest dividend increase, has now hiked their dividend for 60 consecutive years. The company currently has a dividend yield of 2.6%. In terms of valuation, J&J rarely trades at a discount, but right now they do trade at a slight discount to their recent 5-year history. Shares of J&J trade at a forward price to earnings multiple of 17 times compared to a 5-year average of 17.8 times. The second dividend stock on our list today is Broadcom, stock ticker AVGO. Broadcom operates in the semiconductor space with one of the most diversified portfolio offerings in all semiconductors. Broadcom currently has a market cap of $226 billion. They have products for the broadband space, data centers, cybersecurity, wireless connectivity, among many others. The semiconductor sector has been hit hard in 2022, but the demand for chips, especially Broadcom chips and Broadcom technology, will remain important in the years to come. The company has expanded more into software and services in recent years and is in the process of acquiring the cloud computing company VMware for $61 billion. The deal is still in motion and has been approved by VMware shareholders. And this acquisition is sizable, but it will also create plenty of synergies amongst the two companies. On the year, shares of Broadcom have fallen 16%, making the valuation look quite intriguing at current levels. Broadcom is one of the most well-run semiconductor stocks in the space, along with being the best dividend semiconductor stock. With Broadcom, you get growth potential, a solid yield, and strong dividend growth. Shares of AVGO currently trade at just 13.7 times next year's earnings, and over the past 5 years, they have traded closer to 14.6 times. In terms of the dividend, the company has a 3.2% dividend yield and a dividend that has increased for 11 consecutive years. The company has a 5-year dividend growth rate of 32%. The company recently hiked their dividend another 12%. The third top dividend stock on our list is Qualcomm, stock ticker QCOM. Let's go ahead and continue with the semiconductor space with Qualcomm, who is also a leader within their space. Qualcomm currently has a market cap of $131 billion. They have products that reach a number of different industries, including mobile phones, computers, VR and AR, automotive, which is a big growth driver for the company, wearables, wireless, Internet of Things, smart home, and 5G, among many other different areas. The company has had many differences with Apple over the years, as the companies have sued one another on multiple occasions. But even after all of that, Apple to this day is still using Qualcomm products, which speaks to the power and advanced technology that Qualcomm products offer, especially with their popular Snapdragon chip. Many in the semiconductor space have seen their share prices fall in 2022, but Qualcomm has fallen a lot as shares are down nearly 40%, representing a great opportunity to get in this blue chip company at a great valuation. Shares currently trade at just 11 times next year's earnings compared to a 5-year average of 17 times. That is a 35% difference between their historical norms. Shares of Qualcomm yield a dividend of 2.5% currently, and the company has been increasing their dividend for 19 consecutive years, and they currently have a 5-year dividend growth rate of 6%. Now let's move out of the semiconductor space and move more into the consumer staple space. And that brings us to our fourth top dividend stock on our list, which is Costco Wholesale, stock ticker COST. Costco has become more and more popular over the years, and that is no different with my family, as many members and many consumers have turned to Costco for their regular grocery needs. Costco currently has a market cap of $206 billion. Costco offers great pricing on a multitude of different things, which translates into low gross margins, but where the margin is brought up is through their membership sales, which is obviously a high margin. The company has built a very strong and loyal customer base, with renewal rates being in the mid to high 90 percentile on an annual basis. Costco is also a very well-run company with an A+ rated balance sheet. Costco is actually a new addition. When I was originally putting this list together, Costco was not on this list, but the way the stock has reacted after their recent earnings report, I had to put shares of Costco on my top 10 list. On the year, shares of Costco are now down 19%, and Costco shares currently trade at a forward price to earnings multiple of 31.8 times, which is well below their 5-year average of 37 times. As you can see from the fast graph chart here, the blue line represents the 5-year average price to earnings multiple, and for much of the year, Costco shares have been trading well above, actually reaching a multiple as high as 48 times in the spring. But given that shares have fallen, going into a recession, I see Costco as a vital consumer staple stock. Shares could perform well for investors in 2023 with an entry point at these levels. Costco has a low dividend yield of just 0.7%, but they've also increased their dividend at a 12.5% clip over the past 5 years. And they have increased their dividend for 18 consecutive years, inching themselves closer to that dividend aristocrat status. Before we move on to stock number 5, let me tell you about a special promotion over at Webull. If you sign up for a new account over at Webull using my link down in the description below and you deposit any amount of money, they will give you up to 12 free stocks valued up to over $30,000. Definitely take advantage of this special limited time promotion. Dividend stock number 5 is Altria Group, stock ticker MO. Now I understand this one might be a little more controversial, as Altria Group sells products such as cigarettes, cigars, marijuana products, any of these nicotine products, smokeless products, as well as heated tobacco products as well. And the company is in transition more towards these heated products that are supposed to be better for the consumer and better for the environment as well. In terms of the company, Altria currently has a market cap of $84 billion. Altria has been known to be a common stock found in dividend portfolios across the world. They have a large dividend yield, and in terms of total returns, they have performed quite well for investors over the decades. Today, we are continuing to see a decline in cigarette volumes, which is great for consumer health, but the last few times we have seen upticks in volume is during periods of high stress, including recessions. The company is also moving more towards smokeless products, such as their heated sticks, which, like I said, are supposed to be better for the consumer and the environment. The intrigue with Altria is the high dividend yield and the low valuation. On the year, shares of Altria are only down less than 2%, easily outpacing the S&P 500. And from a total return perspective, they are easily positive on the year. Given that, you can still get shares of Altria at a multiple of just 9 times next year's earnings. Over the past 5 years, Altria shares have traded closer to 11.5 times. Buying shares today would also earn you a very high dividend yield of 8.1%. And with all that, Altria shares appear very cheap at current levels. Dividend stock number 6 is Bristol-Myers Squibb, stock ticker BMY. Bristol-Myers Squibb is a pharmaceutical company with a market cap of $166 billion. Bristol-Myers made a large acquisition a few years back, purchasing Celgene for roughly $74 billion. This acquisition was not well received at first, but the diversification, innovation, and the synergies it is adding today is beginning to pay dividends for the company, no pun intended, and investors are beginning to take notice. Bristol-Myers happens to be the best performing stock on this list in 2022, as shares of BMY are up 18% on the year. This pharma giant has a loaded pipeline of drugs, which will further benefit future growth as well as the growing dividend. Given the share price growth we have seen in 2022, shares of BMY still trade at just 9 times next year's earnings. And over the past 5 years, they have traded closer to an average of 12 times. So plenty of growth left just to get back to their average levels. Currently, shares of BMY yield a dividend of 2.7%, and that dividend has grown at an average annual clip of 7% over the past 5 years. The company has increased their dividend for 14 consecutive years and counting. Next, let's move to the telecommunications sector, with stock number 7 on our list being Verizon Communications, stock ticker VZ. Verizon Communications is one of the largest telecommunication companies in the world today, battling it out with the likes of AT&T and fast-growing T-Mobile. This is a stock that I have owned for a number of years, but in 2022 I sold it at $45. And good thing I did, because the share price has fallen an additional 18% since then. The telecommunications sector has seen fierce competition this year, with all 3 major wireless carriers battling it out for respective customers. Growth has slowed in the sector, but much of that was due to the explosion we saw in 2020. However, Verizon executes at a much better level than that of AT&T, which has had numerous poor acquisitions that has led to mountains of debt. The 5G rollout continues to be pricey for these telecom companies, which is one reason I like American Tower, which is a cell tower REIT. And I will be dropping my top 10 REITs video for 2023 soon as well, so make sure you subscribe to the channel so you don't miss that. But back to Verizon, a lot of the downside has already been priced in, and right now shares of Verizon are trading at just 7.5 times next year's earnings, which is a historically low valuation. In terms of the dividend, the company pays an annual dividend of $2.61 per share, which equates to a high yield of 7%. Verizon has increased their dividend for 16 years and counting. Dividend stock number 8 is Lowe's Companies, stock ticker LOW. I have owned Lowe's companies for a number of years, but sold them at the end of 2021 for a couple of reasons. Number one was a stretched valuation. The company had a huge run up from 2020 through 2021. Also, I was looking at the real estate market that was red hot and just had to expect that headwinds were coming. The move to sell the shares proved to be correct, but I am dying to get back into the stock. Lowe's currently has a market cap of $126 billion, making them the second largest home improvement retailer behind Home Depot, who has a market cap of $334 billion. So as you can see, still plenty of separation between the two companies. Home Depot is largely considered the gold standard when it comes to operating efficiency. The company has done such a fine job over there, which has helped build that separation. However, back in July of 2018, Lowe's hired Marvin Ellison, and I have written about this a number of times, but he is one of the reasons that really got me excited about Lowe's. When you look into his background, you see loads of amazing experience within retail and home improvement. He spent roughly 15 years over at Target and 12 years in a senior leadership role at the very own Home Depot, as well as a CEO stint at JCPenney. That Home Depot role is what got me excited because he knew exactly what made Big Orange tick, and he has brought that over to Lowe's. Efficiency and innovation of the supply chain has all improved vastly under his leadership. Lowe's is trading at an insanely low valuation. However, there are still plenty of headwinds in the real estate sector to know, but for long-term minded investors, this is a great dividend stock trading at a great valuation. Lowe's shares have fallen 20% on the year, creating this great entry point. Shares of LOW currently trade at just 14.5 next year's earnings compared to a 5-year average of 19.5 times. In addition to this low valuation, Lowe's also pays a dividend that yields 2% and has been growing for 61 consecutive years, making them our second dividend king on today's list. Not only has the company been increasing the dividend for that many years, but they've also been increasing it at a strong clip. Lowe's has a 5-year dividend growth rate of 21%, by far the highest on our list today. And the past 2 years has seen dividend hikes of 31% and 33% respectively. The 9th stock on our list today is Raytheon Technologies, stock ticker RTX. Raytheon Technologies is the largest defense contractor in the market today. They currently have a market cap of $145 billion. Lockheed Martin and Boeing are the next largest with market caps of $126 billion and $110 billion respectively. On the year, shares of Raytheon have far outperformed the market as they are up 14%, making them the second best performing stock on this list. Given that outperformance, you may be asking yourself, well, Mark, why do you think this is going to outperform again in 2023? Great question. A couple of reasons. Number one, the invasion of Ukraine by Russia has led to many countries, including the US, looking to bolster their military. In addition, the US is spending billions in weaponry to send over to help aid Ukraine in their fight for their freedom. Raytheon continues to secure new contracts that end up paying out over a number of years. The company recently secured a $619 million contract with the US Navy for modifications to their F-35 jets. In addition, they were recently awarded a $1.2 billion contract from the US government to supply additional surface-to-air missile systems to Ukraine. Reason number two, the growing dividend. These contracts continue to fund not only a safe dividend, but a growing dividend. RTX shares currently yield a dividend of 2.2%, and that dividend has been growing now for 29 consecutive years. Reason number three, valuation. Even given the year that Raytheon has had, shares still trade at just 19 times next year's earnings compared to a 5-year average of 27 times. The final stock on our top 10 list today is Microsoft, stock ticker MSFT. Now, this is not only the largest company on your list, but it's probably the most popular company on our list as well. Microsoft currently has a market cap of $1.9 trillion. Big tech stocks across the sector have been under siege in 2022, as the popular QQQ ETF has fallen over 31%, and Microsoft shares have fallen 27% on the year. Valuations skyrocketed in 2021, and in 2022 we have seen the year of the correction. We have also seen a slowdown in spending, and we're also beginning to see layoffs. Microsoft has been one of those companies that has announced layoffs in recent months as a way to cut costs and improve margins. When it comes to Microsoft, they have a diversified portfolio of products, and in addition, they have a very, very strong management team, among the best in the world. They dominate in many sectors in which they operate. They have their popular Windows operating segment, Office 360 products. They're the second largest cloud computing company with Azure, and now they're climbing the gaming ladder with their announced acquisition of Activision Blizzard, which is still under review, but will be a great addition to their Xbox game console. This company is loaded, and they still have massive revenues, strong cash flows, all of which continue to fund their growing dividend. After the year that Microsoft has had, shares are now looking quite reasonable for long-term minded investors. Remember, 2023 is still going to have plenty of headwinds, definitely in the first half of the year. But remember, the stock market is forward-looking. They don't look at what's happening right now. The stock market is looking at what is happening 6 to 9 months from now. As such, right now you can pick up shares of Microsoft at just 22 times next year's earnings, which is quite low for a company of Microsoft's stature, considering they tend to trade closer to 29 times on average. In terms of the dividend, Microsoft pays a low yield and is more viewed as icing on the cake. Microsoft currently has a dividend yield of just 1.1%, but has been growing that dividend at a 10% clip over the past 5 years. And it has grown its dividend for 20 consecutive years, making them well on track to become a dividend aristocrat soon. Well, that wraps up my list of the top 10 dividend stocks for 2023. Down in the comments section below, let me know what is your top dividend stock for 2023. And also, if you enjoyed today's video, make sure you hit that like button, as it truly helps the growth of this channel, and subscribe to the channel, because in the coming weeks you will see videos from my top ETFs as well as top REITs for 2023 as well, and you definitely don't want to miss those. Again, thanks for joining me today, and we'll see you next time. Take care.